Morning, Nick, and how are you? Good to have you back for another Skadi podcast. Bit
Hey
close to the
DT,
last one, actually.
this is a good episode because this has come by special
It
request.
has,
We
yes,
love
yeah.
it when people from the audience suggest things, and this wasn't. This is one we should have known about particularly, but I
Yep,
hadn't really heard about it. Had you?
I hadn't. No, and I feel, well, it's been a very interesting thing to study, but no, I hadn't really heard of it before. And given that we both work for Dutch banks and we are heading to the fine country of the Netherlands, maybe odd that it slipped under the radar. But yeah, it's a really interesting one.
It is.
Uh,
So why don't you let the listeners know what we're talking about today?
Sure. Yeah. Well, today we're examining the near collapse of a company called Vestia over in the Netherlands. And at its height, it had over 20 billion in derivative exposure. It received massive collateral calls. It was in the middle of had a liquidity crisis. There were criminal convictions at the end of this all, executive resignations, parliamentary inquiry, and sector-wide reform was what we saw at the end of it.
So this is big stuff, big
This was big
impact
stuff,
stuff.
big numbers. And at the end of the day, this thing was just a housing association. It wasn't some big conglomerate or big financial institution. It was a housing association. Yet its balance sheet behaved like it was some massive leveraged derivatives book.
So
So,
it's not. So it's I suppose and maybe this is why the person recommended it to us after the Parliament episode, which was received very well, because again, it's sort of a situation that to the eye, you'd think shouldn't be too complicated, and yet the complexity has ended in disaster, perhaps.
yeah, yeah.
Sorry, go on, tell us more.
Yeah. So, I mean, I suppose this episode is going to really be about, embedded incentives, trusted experts, intermediary corruption. We see a liquidity spiral within it, and a lack of governance and what thresholds existed around governance. So yeah, I'll probably now hand to you, Nick, in a way, because it'd be kind of your derivative knowledge, I would say, is better than mine, and you may be able to give a quick derivatives 101 on exactly what they were getting up to.
Well, I think I don't want to get. I know that I hope the shutters aren't coming down for people immediately as soon as we use that word derivatives. And I'm going to use an even, probably an awful phrase now for people, the interest rate swap, and immediately people go, oh no. But I think that's one of the things where I think we pride ourselves on is trying to just cut through the complexities and make things really simple. And actually, these products, I mean, you can get as complicated as you want with them, but really, I think it's important to help people understand this product, from a very, very simple standpoint. And Vestia was a housing association, and most of the listeners, I think, will have had or have, or in the future will have a mortgage, right? So they will go out and they'll borrow long term. And, if they're borrowing on a variable rate, right? They haven't fixed that mortgage, a variable rate. And if they wanted to fix their mortgage, they could go out and get a different mortgage product and go and buy a mortgage and get a fixed rate mortgage. But what an interest rate swap enables you to do is actually just maintain your existing lending arrangements, but just alter them by the way of the interest rate swap. So if you're already effectively paying the bank a variable rate of interest, then you can find a swap provider that will pay you a variable rate of interest. So if you think about it, you've got variable coming in and variable going out.
Yeah.
So that's hedged, neutralizes each other. That's trying to make it simple. And then in exchange, that person that's paying you that floating rate, or that variable rate, you're going to pay them a fixed rate of interest. And that's what you do. And what that does for you is it stabilizes your payments, makes them more certain. You know what you're going to be paying every month. So you're effectively transforming that risk that you face. You now no longer face a risk of interest
your mortgage
changing.
being £1,000 this month, or £1,000 this month, and then 1,500 next month, and then 2,000 a month after. I mean, I'm not saying that things move around as quickly as that, but absolutely, you might go, I'd much rather know that I will pay £1,200 a month, and that will be me done. And I know that my payments will be that for the next X number of years.
So, Damian, if you've got a mortgage, and obviously we're talking about you, so your mortgage is probably £5 million,
something like that.
But clearly, if you were to go out and get an interest rate swap, you want that interest rate swap to be comparable or the same as the size of the mortgage that you have, or the lending that you're trying to hedge. Now, if you were to take out an interest rate swap where the size of that interest rate swap, or the notional, it's not of the size, exceeds the size of your mortgage, then you're no longer, taking as simply handling your risk. You're taking further risk, right? And that is a problem. So that's one of the kind of the multipliers in this. Another one is just on the duration of what you're doing. Just in fixed income anyway, the longer the duration of something, the more the consequent volatility is of, and the sensitivity of that product, and in terms of its value. These things do have a value. And because you have something that's changing in value, up or down, against the person that's providing you the swap, then you have to post collateral against that. And so, while you're, if you like, stabilizing, your income volatility in your property portfolio, what you are doing is you are introducing, though, the kind of liquidity volatility. So it's kind of changing your risk profile in a way. So it's something that people should think about, that when they're encountering interest rate swaps and these different products, really thinking about, are you looking at this problem just head on, just as a kind of an income type situation, or are you thinking about, and should you be thinking about, and you certainly should, about what could be the liquidity impact of the product that you're looking at? And that's anything that happens where you've got, mark to market or collateral.
Yeah, and what we've seen in banks, and what everyone is, I assume, well aware of, is people run stress tests against these sort of things to go, okay, this is our exposure that we sit with. Now, if we run, a stress test, which is, if interest rates jump X percent, 2%. I mean, I think the Bank of England does this as part of its stress testing. It will go, okay, plug these assumptions in, and what spits out at the other end. And people can then also go back and go, well, we can run it over the Asian financial crisis. We can run it over the Lehman crisis, whatever it may be, to sort of look at, where, quite often there are sort of things that you assume are uncorrelated might suddenly correlate. So you then stress test to see that, okay, well, actually, we, that our maximum possible loss given the stress test parameters might be X or Y or Z. So, yeah.
Yeah, I mean, to be really simple, I just think in any kind of review, at stress tests or whatever, just ask yourself, are you understanding the picture, or are there other secondary consequences of what you're looking at? That's the simple, lesson, I think, that people can take away from this. Now, in the case of Vestia, ultimately, you had a rogue treasury manager. Now, you and I have covered rogue traders to death. We love talking about rogue traders. We only did one, I think, 3 episodes ago on the LPG market, and we've done plenty of others. In fact, one of our most popular episodes, aside of the Lloyd's names episode, which is by far our most popular episode so far, but is again about the the SocGen rogue trading incident on the Delta 101 book. So we've covered rogue trades, but not really rogue treasurers. I think the only one that we've kind of come close to was the the many bank accounts of Michael Viney. But in a way, it's a kind of comparable situation where you have this expert. And you're going to talk much more about the expert in this case. But the point is that how, as someone reviewing this situation, as an investigator or maybe as an auditor, like scratching their head and thinking, is everything right here? you might just say, well, it's simple, follow the money, follow the fees. I think what's really hard with interest rate swaps and a lot of these other kind of FX type derivative products as well, and things in the FIC world, is that these kind of swaps rarely show explicit charges. It's rarely broken out actually, and the compensation paid to dealers is often, if not always, embedded in the fixed rate quote that's quoted to the customer. And the other thing too is just how the size of these things work, because you're talking about really small margins. If we were to sort of say, as an example, 5 basis points. So for anyone listening that may be coming out of university that hasn't encountered a basis point, which is what people talk about in the markets, 100 basis points is a percent.
Yeah.
And so if you've got 20 basis points, you're talking about 0.2%. And these basis points become important when you're talking about commission arrangements for people. How many bips or how many basis points? I'm real kind of advanced market lingo here, TT. You love it. Yeah. but it's true. So going to 5 basis points, which seems such a small amount, on 500 million euros over 30 years, 5 basis points, that's 250,000 euros a year. That's 7.5 million euros over the lifetime of this product as an incentive fee for someone. Now, if you take Vestia's portfolio, which I think at the end was around 20 billion euros, you're talking about 10 million euros annually being paid in the kind of embedded dealer spread. Now, that's a very lucrative customer. And then we go back to, whether it's rogue treasury, rogue trading. When you've got a profitable situation, you're going to find internally people are going to be resistant to people looking at that in themselves. They're going to start, just explaining away problems, explaining away things that may not normally add up, because it's lucrative for everyone. And unfortunately, profitability, does make people look the other way, or can have a tendency to do that. So this was a very, very lucrative situation.
And just to go back, Nick, so you said that these fees are sort of embedded, and what would you mean by that?
I mean that see, if you were dealing in your world, in the equity world,
yeah, exactly,
you'd quote a price or whatever, you'd execute for someone, and then they'd see the commission.
Correct. Yeah. So we'd send a client a fill, which would be, a gross price and a net price, and obviously the difference between those would probably be, certainly in equities these days, around 5 basis points, maybe a bit less depending on the sort of client you're dealing with. But I suppose when the confirmation is sent, what it would say is, your gross price is this, your gross notional is that, and then there's a small, 200 euros, whatever it may be, of commission, and then there's your net price. So I suppose it's very transparent, and you can go at the end, you can run a batch file and go add up all those commission numbers, and okay, I, salesman X, or have earned 5,000 euros of commission. Whereas what you're saying is you can't see that number per se in these embedded.
I think it's hard for people to look at these kind of products and immediately kind of work out whether this is what kind of price gouging is going on, that kind of stuff. It's because it's not broken out. Where I'm not giving away any secrets to anybody, but of course, people that are placing these products on the desk, so the distribution teams or the sales teams, are going to be earning themselves internal credits, so sales credits. So, yes, there are measures that you can look at, but it's just harder. It's harder to see those aren't going to be broken out on customer confirmations necessarily. In the case of Vestia, again, what this treasury person started doing as well was dealing in forward starting swaps. So these were swaps that were taken on in the understanding that exposure would grow in the future. And because this is, again, not a vanilla product, the spreads on this are even wider. So you're talking about, probably double the kind of brokerage spreads that you would have had on the other products as well. So these revenue pools become really significant for people, and especially when you're dealing with massive notionals, when you're dealing with very long maturities, and the revenue pools, they do influence people's behavior. So again, on this stuff, this is down to your independent price verification. What can you see? How can you test this stuff? Does your independent price verification go further? Does it look into things like the sales credits and start questioning that, looking at whether a particular salesperson with a particular customer is repeatedly earning that kind of outsized credit? When they go away on NTA, someone else takes over that arrangement. Are there differences? Are there things that people wouldn't would be surprised at the amounts that they're managing to take to record in credits against this person? So we've talked about these kind of products, the way that they were incentivized to kind of build up this product, and there were things that were getting put into Vestia's portfolio, like these forward starting interest rate swaps, that meant that you had this book of financial instruments building up, incentivized by having an insider that was motivated to play with the balance sheet with their responsibility. But it was the crisis that really damaged Vestia, because what happened was the rates that were in the marketplace fell sharply, and for these long dated swaps that they had on the books, this meant that the value of them moved really against them.
And
in favor of the banks that were providing them.
The sensitivity of something that is that long dated, I assume, is very large to I assume at the beginning the assumption is you're hedging out your interest rate, and if rates don't really move, then one, I suppose you wouldn't have needed to do the swap, but two, you're protecting against it. But the assumption is they're not going to move too aggressively, and if you do get an aggressive move, suddenly the sensitivity of the positions you're holding is extreme.
Yeah, it's when this stuff comes into the real world, because accounting wise, it's all fine, but we're not talking about accounting adjustments. We're talking about people really worrying about your credit worthiness, realizing that the market circumstances have changed. There's a valuation mismatch between us, and I need you to post some payments to cover yourself, to show that you're good for this position. Should everything not, should anything untoward occur. And so you require this posting of collateral or cash. And that means that for Vestia, that had liquidity, that shrunk massively. And it actually shrunk to such a situation where they were forced to do what anyone does that runs out of potential credit or liquidity. You have to start looking around at your portfolio and think about things that you're going to sell. So you start the asset sales. And when you have a counterparty that starts to begin selling, and there's a sort of liquidity cycle, a tightening of liquidity around them, people can see that, you start to then get people's confidence, eroding in that counterparty. So people's confidence in Vestia, they started to query how good it was as a counterparty. A bit like, in our previous episode where we're talking about Parliamentary, it was a different situation, but they're, again, a serial borrower saying that they had lots of cash around. There's an erosion of confidence. Things don't add up. And similarly, people can we're looking, I think, at the Vestia situation and thinking, my God, this is not looking so good here. This is, a housing association, but we know that they're involved in these kind of products, and they're now having to sort of liquidate stuff. There must be some problem here. And that can then feed into the liquidity tightening further for them. And you get this kind of self-reinforcing loop. So, and when you have things like the forward starting interest rate swaps on the balance sheet, this all amplifies, the dynamic that they were facing. The more of the complexity that's in the portfolio causes greater problems for them. One of the things that happened for Vestia is that these interest rate swaps really, converted interest rate moves into liquidity risk for them. So I think for corporate treasurers looking at their positions, or indeed auditors looking at some kind of treasury function, or any lending or borrowing function within a financial institution, ask yourself if there is a move in rates. Again, what does that do, not just for your P&L, but for your liquidity? How long could your liquidity stand that for? Do you have enough tools, enough resource to manage that kind of cash flow squeeze? So that's the technicals. I hope I've done it justice, and I hope people have understood. And but Damian, I think what we should do now is talk about the people behind it. So we've talked about this treasury expert. Tell us more about the treasury expert.
So yeah, this is a guy called Marcel de Vries, and I apologise on my pronunciation to any of our Dutch listeners, but I think that's vaguely in the ballpark. So he was their treasurer from 2002 until being arrested in 2012. It says he was an accountant by training, but no formal expertise in complex financial derivatives.
So can we just have a shout out to everyone studying accountancy? Because that was what saw off Parliamentary, and it's what saw off Vestia as well.
Indeed, yeah. And he was appointed by the CEO, a guy called Eric Stahl, and given quite wide autonomy over the finances of the firm. So he was the specialist. He was allegedly the guy with technical authority. So he sort of was built up into this position where, what he said went. And he was, in the eyes of the company, he was like, no, leave this to me. We can do these swaps. We can start to, have known payments over the next, few months, few years, et cetera, et cetera. So he was the sort of kingpin within Vestia itself. And he was dealing through another guy who we'll come on to and do a bit of work on a bit later, but a broker called Arjan Grieven. Once again, apologies for my pronunciation. But yes, so he was so Arjan, who we'll move on to, was the guy that was the broker who this guy Marcel was doing trades through. So he was instructing.
So he wasn't going directly to the banks then, the treasury.
Correct.
He was using an intermediary. And just going back to the treasurer, because you've mentioned that he was really seen as an expert. What about separation or concentration of roles? Because when you've got someone like that who has all of the knowledge, I think again people approaching an area where there's the people keep pointing to the one key person. I think you've got to ask yourself about, if this person is a rogue operator, because they clearly have all of the knowledge, are there at least some mitigating controls in terms of what they are, the processes that they are controlling?
Yeah, checks and balances, yeah.
Exactly, checks and balances. But I think in the case of Marcel de Vries, I think he had a lot of autonomy, just really a bit like Michael Viney at BGC. I know it's not the same situation. That was a real direct fraud and theft, and people can look back to that episode, which was only, I think, 3 or 4 episodes ago. But similarly, real autonomy for Michael Viney and trust. People just, not questioning what he said. And I think it's the same with this guy as well, within Vestia. As you say, dealing through an intermediary.
So this was, and actually, obviously, as we said at the beginning, we weren't too knowledgeable about this topic beforehand, and when I was sort of doing some research into it, my assumption at the beginning was, well, these guys, it's a big housing association, they will have bank relationships with big grown-up banks that we all know and love, and would therefore be dealing straight to the desk there. But actually looking into it, they were dealing through this intermediary, a broker called Arjan Grieven, which, I mean, obviously would strike me as odd anyway, just as a bit of a flag. It's like, why? How did this guy get set up? Surely there must. I assume if he's a one-man band or working for a very small broker, you would have to do decent KYC checks. You'd have to understand that there's quite large sums of money possibly that are going to be transacting via this guy. Where was the oversight over that? But yes, this guy
it lends itself to a kind of outsized dealing relationship. If this guy, as seems to be reported, that he was operating for a number of different entities or companies, you kind of looking at that brokerage account and kind of lining it up in these products and going, well, does that really work for the size that they are? I guess the flip side, though, red flag too, but also, if you're Vestia or any other housing association or dealer in interest rates, doesn't really matter what you are, that there is a danger, I think, that if people work out who you are, and this happened in the convertible bond market.
Yeah, happens.
It's a very simple example. Once you know who a customer is and you can then kind of work out what they're going to do. And therefore, if you can work out what they're going to do, there is a danger that you will skew the pricing towards that counterpart.
Correct. So yeah, it may in fact be relatively normal that you use a broker if you're a housing association. Let's say, you may go, well, actually, we can. I mean, you might even say, well, we don't have the expertise necessarily, so we would use the broker to help us broke to the major banks. They'll have a good understanding of what we're looking to do, etc. But it certainly would raise a flag to me. But as it turns out, I think around 10 million euros in bribes and kickbacks went through this broker, and some of which then circulated back to Marcel himself. So, it was there was definitely collusion within the Vestia, the end client, and this broker who was then facing off against the banks. So
I think this is the point really about the the obscurity and the lack of transparency in the pricing. When you're sitting inside a corporate and you're seeing these swap spreads, it's one thing for us to say, oh, you look at the sales credit. Well, you can't. If you're in the corporate, you can't do that. You can do that inside the bank. So where you've got an interest rate swap product that's going, from a bank to an intermediary to the corporate, very hard for the control functions inside that corporate to actually see, what gouging could be happening.
Yeah, and there's no, is there a benchmark per se? You don't know what the other housing associations in the Netherlands are doing necessarily. Maybe if it's a bank versus a bank or a hedge fund versus a hedge fund, you can get a feel for what sort of standard rates are. But you sit as your own island to a degree, so you don't really know. I mean, maybe that's one of the reasons you use an alleged trusted broker, because they will hopefully be able to get you, in inverted commas, the best price, etc. So yeah, it's interesting. And the third person we were going to look at was the CEO, a guy called Eric Stahl. He resigned in 2012 as well, but was not criminally convicted. But there have to be obviously big questions around governance, around how he appointed this guy, as we've alluded to, what checks and balances were in place. You'd like to think there's questions asked of the board. It seems to me that the board probably didn't have understanding of derivatives and the scale of the derivatives compared to the size of their outstanding. So, was any independent expertise obtained? Were there risk thresholds? Were they enforced? And was there any concentration of authority challenge to Marcel? So yes, he's the third person in this triumvirate of characters within this story.
So it's a very hard. I mean, it is. I think it's very, from the kind of corporate's point of view, it's a very hard situation, because it's you're trying to detect these excessive commissions. When those commissions are paid externally, internally, how do your control functions see them? So it's really, really hard. probably a lot of people just assume that the fee's embedded and therefore isn't material. And it's really, really difficult if you've got incentives that, aren't broken out on an invoice, people. So you really have this perfect storm, if you like, where you've got, a broker dealing with a key person treasurer. And I guess that's the other thing that if you're inside a corporate, but it holds for other dealing relationships too. If there's a reliance on one particular dealing relationship, you have to query why that is. Why is that the case? And what that can reveal potentially about what is happening between different people. The case of Eric Stahl, who was the CEO, and the two prior, they did go to jail, didn't they, Damian?
Yes, the broker and the treasurer, yes, they did both go to jail. Stahl, its claims did not, was not criminally convicted, absolutely.
No, I don't think, well, certainly he was found not to have had any criminal intent. There was a failure of oversight on his part, but I can see when I was sort of reading around this that he's still a very colourful character,
Right.
And was running into, there's still the press reporting on his dealings in South Africa, for example. Again, he seems to be someone who, has carried on life after Vestia, and carried on seemingly kind of taking outsized payments out of places he was working and so on. So I'm not sure necessarily whiter than white, but really, really, interesting. He also, I think, relocated out of the Netherlands to Curacao, which raised questions at the time, slightly kind of irked people. I don't think it made a change about jurisdiction necessarily, but it did, I think, make him kind of like a little bit harder to reach probably by certain people. But I think, again, just a simple question for people, in control functions, whether they're auditors, whether they're compliance people or whatever. When you encounter anyone, very, very ambitious, does that ambition override, their understanding of the risks that they're running or overseeing? Is a good question and a good test. These are the kind of really simple, people skill type queries at the start of an audit or review, when you're looking at people. So that was that effectively in a nutshell is the story of Vestia. You have this inside man, a lot of expertise, people, really kowtowing to their knowledge, and effectively, not separating out roles, giving that concentration of responsibility to one person.
Yeah. No challenges to
what
was going on.
An external dealing arrangement which enabled those people to monetize, in hard terms, that portfolio that they were operating, which was very, very large, seemingly, very, very vanilla for a housing association, and dealing in products that were becoming, ever increasing in complexity, and that led to the disaster. It was not, it wasn't essentially a single failure, if you like. It was kind of layered. So complex derivatives, the embedding of dealer commissions, the intermediary commission loops, trusted expert dominance, liquidity spiral that they got into, and then just the gaps in oversight. So
yeah, it's incredible really, in a way that no questions were asked, that the trade was always done through this one intermediary. There was no, have you gone out to the market to check others? How can we always deal with this guy? How come when we're looking to mark things, did they only take that guy's, often you might ask your broker to give a mark back, when is that a loop coming back to you of what you want to hear, or what the treasurer wants to hear,
Yeah, that's an interesting question, because if you're only dealing with one counterpart, how does your price controller know who else to go out to ask a query from? to get a level.
But you'd think that, you know, even in this, well, not that swaps are particularly complex, but there are always checking mechanisms for what the price in the street is for X, for Y. Even if it's got quite bespoke terms, you know, you should be able to look and go, okay, well, this, you know, what was going on with that marking? Absolutely, you know, there just seems to be very, very little oversight here. So
yeah. So again, anyway, final reflections, I guess. So, you know, if you're looking at your own portfolio, where are the embedded incentives? You know, untransparent, unrevealed, unexamined. Is there any part of your portfolio where the liquidity or the risk of liquidity is undermodeled or not modeled at all, not recognized? Intermediaries, you know, this is the lesson from Vestia. You know, are they sufficiently scrutinized? Are they recognized? And when dealing with an internal expert, you know, where is trust, particularly from the superiors, but it can be from anyone around them? Where is that substituting for actually verifying what they're saying and what you know, the positions that they're putting on the institution? So, you know, if rates moved sharply tomorrow, you know, what breaks first in the institution? Is it the earnings? Is it the liquidity? Is it the governance? And I think the answer to that question really defines whether you're hedged or exposed. These are hedging products. And Vestia, without a doubt, was exposed. So there you go, Damian. That's the story of Vestia. Thanks a lot for the suggestion.
Yeah, no, enjoyed that one. It was interesting.
The listener, who remain nameless, but I hope they've enjoyed that dive into the Vestia situation, and we'll be back with more interesting, you know, tales from the market that we're going to review and potentially unravel the complexity behind and find out lessons. All right, this is Skadi, the Skadi podcast. Thanks for listening.